Hey everyone, it is Evan here from the Trade Risk on Friday, October 12th, here with a weekend market recap video. We're going to cover all of the major markets, the current market environment, and then finish off looking at some sector analysis. So it was a wild week. We saw volatility come back into this market, or certainly increase in this market. We saw sharp sell-offs across the board. There's lots to talk about. I got a handful of bullet points that I want to get through in this week's video. So let's jump right in to the weekly time frame. S&P 500 cash market. We finished lower 4.16%, and that was off of the lows made on yesterday's trading session, on Thursday's trading session. But first thing to note is the large expansion in range here this week. We saw a significant breakdown of a very critical level. We talked ad nauseum about this 2872 level over the past month and a half or so of trading, saying that this was going to be an important area for the bulls to hold. And in fact, just on this midweek video, we talked about the potential for this to be a mighty big air pocket under here, where if we started to break these lows, we could see a quick move down to say 2800 or so, and we absolutely got that. It happened in very short order, you know, here we are closing now at 2765. So when we look here at the weekly time frame, we did erase a few months worth of trading over this week's selling, and we find ourselves kind of catching on to this longer term trend line now, which extends, if I zoom out on this chart, from the 2016 lows. Now, of course, this trend line, you can sort of fit this to sort of fit your narrative. I'm not meaning for this to be precise by any stretch, but you can see there are multiple touches here. This is approximately where the market held back in January, February, March of this year on that early year sell-off. And now we are back to it, closing right at this long-term level again. So I think if you are a bull here, this is a critical spot to find some stabilization. You really would like to see the market take a pause here, let dip buyers show up, try and really hold these lows at this week of around 2715 or so. That's going to be the best case scenario to prevent sort of further damage and a further pullback, which would set us up for the next sort of general zone would be all the way down around 2550 or so, this year's lows, if we start to really see selling pressure continue over the next couple of weeks. Certainly don't have to get there, just levels to pay attention to. So when we kind of switch over now to another view here of some levels to pay attention to, we go down to, now let's go down to that daily chart. This 2800 area, that is where we are find ourselves trapped underneath. If we go to this actual board, I'm sorry, we'll stay on this board. This 2800 area, that is going to be where we want to see, where we would expect resistance to be at this current time. And for the market to start to repair this damage, we're eventually going to want to see it back over that area. For now, taking things one step at a time, we're really looking for the market to just catch its breath, to work off some of these oversold conditions, and to really see what's in store for this, for sort of the next directional move here. We just really unloaded in fast amount of time. We're stretched by any metric. You could certainly look at, say, even just the VIX here. If we look at this week's action for the VIX, we were up 20% last week. We find ourselves up almost another 50% this week, and that's certainly well off of the highs. We're closing at around a 22 for the VIX. If we zoom out a little bit further, you can see this is approximately where we were closing back in March, April when we had that last sell-off. And we also know that the VIX really doesn't like to stay persistent up in this general zone. We tend to get, you know, that mean reverting decay in volatility as it starts to spike at these levels. So if we look at VIX, if we look at put-call ratios, if we look at the number of stocks above some short-term moving average, we can really pull up any metric at this point and verify that yes, we are oversold. There is fear out there. We are at a potential short-term extreme, but as we know, the markets can easily get more oversold. It requires discipline if you're buying to manage that risk, know your stop loss, and be very cognizant of your position size if you're starting to nibble in here, if you're starting to look at some reversals and some buying. Don't think it's crazy, but you do want to have some experience, you want to have a plan, and you want to be, of course, minding that outstanding risk. So when we really look at the levels here going ahead, we'll go to the SPY chart now, because I know a lot of people like to look at these levels. If we look here now at a SPY support and resistance areas, we have this approximately 280. That is that band that we were just looking at of resistance that we were just looking at in the cash market. That's going to be kind of the upper level where I would expect some trouble for this market to to rally above in the short term. And I also say now we have this support around this 270 area. That was approximately where the market traded down to in July. That is where we sold off to yesterday. I think this, call it 10-point range between 270 and 280 is a very reasonable spot to see the market probably still in a fairly violent fashion, but still kind of thrash around in here. And if either one of these extremes are taken out, predominantly the lower end here, if this is taken out, then of course it's really risk back on and look out below. If we start to rally back up into this 280 area, I'd be a little cautious. I wouldn't necessarily be an aggressive buyer up here. I'd still expect for there to be some supply up here, given the fact that we sold off in such extreme fashion. And perhaps we get a scenario of a rally up to this 280, 281 area. Maybe we overshoot it a little bit into 282, and that's where we find some type of lower high, a rollover, and then a retest of these lows. And there we have some real information to see if this low can hold on a retest. Now, of course, that's just one situation, that's one example, that's one possible play out of this market. There's certainly, it doesn't have to unfold in that fashion, but I'd say that's a reasonable approach to see some type of, perhaps call it a dead cat bounce next week, unwind some of these extremely oversold conditions, and then let's gauge the reaction. Let's see if we roll over, and then, watch these prior levels. That's really how I'd be playing it. So, as it stands now, I would say that the one positive I see here on the close on Friday is the fact that we didn't see a complete puke before the weekend. And I do think that's mildly encouraging, the fact that we did see such a sharp Wednesday, Thursday sell-off in the market. Generally speaking, come Friday, not many people are going to be too keen on holding lots of exposure over the weekend. The fact that we didn't completely unravel and we didn't see margin calls perhaps cascade through any of these aggressive accounts or dip buyers or whoever else that might have got blown up in this spike up in volatility. I think that's actually a fairly encouraging note to see the market sort of print an inside day. Again, no change structurally. It's still a damaged market, but at least the rubber band did not stretch even further. So that is sort of the way I am looking at the market now overall. I think we have some levels to pay attention to. I'd say make no mistake, it is certainly a trader's market at this point. Volatility is higher, ranges have expanded. It's much easier for day traders to make some profit in this type of environment. And if you're real tactical on the shorter term swing trading, it's easy to get chopped up. You probably have to extend out those stops and position sizes accordingly. But I think it is obviously an easier environment if you're more experienced and a shorter term trader. So that is, I think, all I wanted to say about the S&P 500. We did see earnings season kickoff underway with some of the large banks this week, or today specifically on Friday. They didn't go over so favorably. We saw, continued selling pressure, a rally off of the lows in the financial ETF. We'll talk more about that towards the end of this video. Let's take a look at some of the other major markets here. We'll look at IWM next. So if we look at IWM, this has continued to be the underperformer here on a relative basis. And in fact, it is breaking down below some pretty critical long-term trend line of support. This 2016 trend line that we drew on the S&P 500, if we extend that, the lows here all the way up to recent highs on the IWM, you can see we are very clearly below it, really regardless of how you draw it. I know, again, if this isn't exactly precise, but even if you gave it a little more room, we definitely have broken down from it on heavy volume. We totally overshot this 160 area, which is what we mentioned as a level to pay attention to in the midweek video, and really this continues to look pretty sick with the MACD, with momentum continuing to make new lows. So the Russell 2000 was sort of the canary here that broke down earliest. It continues to struggle here without finding much support. It is extremely stretched in the short term. So once again, I wouldn't be surprised to see some type of snapback here in the Russell 2000, but given how fierce this selling has been, it's probably a rally or a dead cat bounce to sell rather than getting too excited about it. But again, this really does depend on your time frame, your strategy, etc. So I won't give any blanket comments like that can be dangerous if misinterpreted by different time frames. Regardless, when we look here from a price action perspective, we did see, just continued a follow-through breakdown of important structure and key horizontal levels. That is never a good sign. V-shaped rallies can happen, but it is a point at which we should be fairly conservative here. The one, the one optimistic note I will leave here for the Russell 2000, what we talked about a couple weeks ago, when we look at the monthly chart here, we can see that we are still extremely positive here. We're coming off of a new high in momentum measured by the MACD here on my chart on this pullback. Generally speaking, when you have new highs in momentum, those dips are, those kind of first dips off of fresh momentum highs are generally speaking buyable, or they generally have, dip buyers waiting eagerly. This is again a monthly time frame, so you have to, keep your perspective in check here when you're looking at a dip on a monthly chart. That could easily mean 10-15%, kind of like we're seeing here, but that is a slight, positive constructive note, I would say, is that we have had a strong momentum reading there on that long-term time frame. So that is the Russell 2000, still looking extremely bearish there, but absolutely ripe for a tactical bounce, as I would call it. And the NASDAQ 100 is actually, holding up fairly reasonable here. This did close. I don't have the 200-day moving average on my chart. This closed above it. It took out Thursday's highs here. It was up 3%, closing Friday session near the highs here and holding and respecting this important 170 horizontal level, the July lows here. So the Qs, I think, is interesting. It did, come off quickly. It certainly, made an approximately about a 10% very quick correction here. But it has rebounded now just a little bit. It is certainly not out of the woods, but at least constructive to see it hold the 200 period and the 170 level here and take out Thursday's highs on this bounce back. Still think you need to be cautious. Again, mind your position size, so on and so forth, but slight optimistic view there for the Qs heading into the weekend. So all in all, I think that is really kind of a rambling of different thoughts there. Hopefully that was helpful on the market environment, some levels to pay attention to. And again, I think it's a spot to, if you're uncomfortable with this, if this is the first time you're seeing such volatility, then it's fine to just take a sideline view, sit on your hands, certainly reduce your position size if you are trading. There's no harm in just waiting for, more certain, smoother markets rather than, pounding your head against this type of volatility. So that is what I got there for the market environment. Let's jump into some other markets here. We'll go to TLT next, which did see a rebound rally here, 1.27% to the upside. It was down 3.61% last week. Nice kind of flight to safety here as equity markets get pounded. Even though we are seeing some tightening across the yield curve, the TLT kind of safe haven still seems to apply here, that if equity markets are going to get taken out back, then TLT is going to see some love. So TLT, nice rebound here. It's still under this very key 117 area. It's still a cautious market, I would say, on the long side. We had our short position in here. We shorted this last week on Wednesday on this breakdown, covered half last Friday, and we were stopped out of the remaining on Thursday. So we captured a nice little trade on this. Again, not looking to be a hero. It still looks vulnerable for our strategy, at least our setup that we were looking for. This was enough of a rebound to pull us out of the remaining shares there. But you know, I still would be suspect here on this rally. If we start to magically get back above this 117 area in quick order, that would certainly change my opinion on this market. But as long as we're trading below here, I want to be cautious, and I do think rallies should be suspect here for the TLT. Next up, if we go to oil, this was down 3.63%, kind of rolling over following the tail up here on last week's trading. We saw oil trade all the way up to approximately 1624 here in the USO ETF. We saw the good fade into the close and now a breakdown here. Still, you know, when we look structurally here, not a tremendous amount of damage. There's certainly been a lot of ground that got covered to the upside here in USO. We are back below, however, the July high, so would want to be a little bit cautious in the short term, but if the bulls can turn this into a higher low pullback, then certainly they're in good shape. For now, though, I'd want to see us back above 15.25 on a closing basis. That would keep me optimistic there for the trend in oil. If we go to natural gas next, we can see this did break this accelerated trend that this really launched higher from just a few weeks ago. Covered a lot of ground in short order, about 21% for natural gas. It is now pulled back, broke below a couple of days worth of lows and this trend line. So we're going to see again, kind of very similar to the USO. Can the natural gas bulls put in some type of higher low here? That would be optimistic. For now, just be paying attention to this, and maybe we get some type of pullback entry here later next week. Finally, if we go to metals, gold is again very similar to the TLTs, treated generally as a safe haven asset as equity markets are sort of de-risking. You generally get flight into TLT and gold, and this week was no exception. 1.26% to the upside, very heavy volume coming in, and you can see a nice kind of takeout of the prior, 8 or so weeks of trading. So it is still in a tough spot. We got the MACD finally closing in positive territory, but with this good volume coming in, clearing through this consolidation, we certainly have a short-term trend emerging to the upside here in GLD. So if we're tactical, if you want a tight stop here, really, you know, you'd want to see us just continue to hold above this cluster of highs here. We don't want to see this completely roll back over into this old range. So if we can stay above 113.50 or so, you know, that would keep the short-term trend alive for gold, and maybe we see a more meaningful sort of retracement get put in after such a brutal kind of beating it's taken over the past several months. Silver, on the other hand, not quite as encouraging here. It did close flat. It kind of makes sense. Gold is definitely more on the safe haven asset. Silver doesn't really apply necessarily in that camp. We do see on the daily chart, though, positive MACD, which is encouraging to see. And again, if we can continue to trend higher here and hold above these recent highs, that is certainly optimistic, but we don't have such clean structure here like we do in GLD, so might be a little less interested there personally for silver. Now let's go to the sector analysis here. Let's see what held up. Everything was down this week, so we don't have too much in positive territory. In fact, everything was down, right? So even XLU was down on the week, a little over 1%. But when we look here at the XLU chart, this was the best performer on a relative basis. This makes sense. It is the utility area. It is the defensive area. Again, sort of a flight to safety when more risky assets of equities are selling off. XLU here, though, however, you know, on a daily chart, not really that appetizing. There are clearly some individual stocks that are holding up better. There were many utility names hitting my scans, especially earlier in the week. So I would look underneath the hood here for XLU and start looking at some of those other names that could be shaping up a little bit better, cleaner trends, breaking to new highs. I think you'd certainly be able to find them if you dig into the XLU here. Weekly chart, though, just really not that interesting as XLU as a whole. XLP was the second best performer here this week. It was still down 1.72%. Still is in a tough spot here. It broke trend a couple of weeks ago, and it really hasn't been the same since, ever since it broke down below this $54 area. Tried to get above there a couple of times, and then certainly it broke down earlier this week. So XLP kind of in the penalty box. Again, individual names, you're going to find some that are setting up a little bit better. And finally, discretionary ETF was down 3.12%. It does make it into the top 3, but certainly nothing to get excited about. The weekly chart, we saw more follow through to last week's breakdown. We talked about this breakdown looking pretty ugly here last week, and we saw even more continuation on heavier volume. So for me, XLY really not that interesting. On the downside, let's see what got beat up the most. It was materials, looking pretty horrible here, really, with this looking to be a fairly capitulative week here. Very large range, 6.7% as this breaks to new 2018 lows, and we're back to 2017 levels here, and we're below all this prior structure in here. Materials are certainly oversold here in the short term, but they look horrible from a structural basis. I would not necessarily be thinking that these stocks are going to be setting up for a long-term basis until this really does get some time to repair the damage here. I think for shorter-term tactical trades, a week or so, if you're looking for some type of rebound, this makes sense. But for now, it is looking really bad here for materials and industrials. See, at least, this week performance was just as horrible. It was 6.2% for XLI, 6.47% for the materials. At least the industrials, however, are holding up above 2018 lows. We're not breaking below all of this supply in here. This clearly is not a good week, but at least it is, again, at least holding above some of the supply in here. It did break trend and did do it on some heavy volume. Finally, financials, which did just start to report earnings this week. On Friday, we had some of the large banks reporting. Did sell off this week. They were the third worst performer, 5.61% to the downside, threatening the 2018 lows, but it's still holding on. So this is going to be a big battleground right around this 26 and a quarter area. That's where we're going to want to see this market hold next week as we have more of those financials starting to report earnings. Let's pay attention to this. Just like materials, what we don't want to see is a complete loss and breakdown of this structure here. We'd like to see the July lows hold. That's going to help support this market. It's going to be an important area for, just the broad market in general to hold on to and prevent further selling. So that is, actually, let's talk about energy just super quick because it's very similar comments though. You can see we're back. We had a brutal week for energy as well. We're back to the August lows here. Arguably, you could still make a case that it is still holding in this sideways channel here on a weekly basis. So again, very similar comments to the financials. We'd really want to see this $72 area hold. Of course, that's going to be impacted by oil, energy, and some of the other commodities and what they do. But also, when we start to get some company guidance out, that's what we're going to want to pay attention to. So that is it. That is what I have for this week's video. Thanks so much, as always, for tuning in and watching. Hopefully this makes some sense of some of the craziness we saw this week, and congratulations for making it through. Take a couple of days off, come back fresh Sunday night, review some of those charts, take a look at what you've done, what you can improve, and think about how you can adjust for a higher volatility environment, just in case we do have it to stay here for a few weeks. Be worth rethinking and kind of pulling out the old the tool set for just larger ranges and slightly more elevated volatility for your strategy, for your time frame. So that is what I got. Thanks so much. Enjoy the weekend, and I will talk to you guys next week.